Good morning. It's Friday, the 6th of September, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital, usually, but in transit right now. The take, worshipping the sun. Indians worship the sun as a source of life, as many civilizations do, going back to ancient Egypt. Increasingly, it is a source of energy as well. Solar power in India is now touching 20% of total power generation in the country. Overall, fossil fuel power generation is now at 53%, and I would say only at 53% because it is reducing by the day as non-renewables catch up or rise. The first half of 2024 saw close to 15 gigawatts of solar capacity being set up, the highest ever for a 6-month period. Interestingly, some 87% of the solar power generated in India is grid power, or produced at large scale and pumped into electricity grids, mostly run by state governments. The other 13% comes from rooftop solar, which means quite literally on the top of your roof. And that is the opportunity. Before we come to that, solar power generation in itself is getting cheaper and cheaper. The only problem is that when you combine it with battery storage, which you need for nighttime supply, when the sun stops shining, the cost rises. The combined cost is twice as that of fossil fuel-based power. Dr. Ajay Mathur, Director General of the International Solar Alliance, a global body grounded in India, told me on a panel titled Reaching the Unreached yesterday at the International Solar Festival 2024 in New Delhi. The title festival actually is quite apt for solar energy, suggesting it's something to celebrate rather than a seminar to grimly ponder over the future of energy. Now, the economics of solar are still a little tricky when you look at grid power, but can be a little different when it comes to homes. And without getting into too much detail on the economics, let's talk about the homes. I found it interesting to learn from the High Commissioner of Australia, Philip Green, that Australia has now the highest per capita of solar energy in the world. Not just that, 1/3 of households in Australia, that's almost 30% of households in Australia, have rooftop solar, according to Mr. Green. The Clean Energy Council says rooftop solar photovoltaic systems have touched 20 gigawatt of capacity in Australia last year, and it's the fourth largest source of power and represents over 11% of the country's power supply. Australia is a small country, but the percentage is quite surprising and thus a good example and illustration. There are calls for more subsidies for batteries to create the flexibility of storage and thus being able to access power at all times. That's the Australian example. India has a new rooftop solar program launched in January this year, targeting 10 million rooftop homes, riding on previous schemes launched in 2022, including subsidies for the cost of solar panels. Some 13 million Indians have already registered for this, apparently. So the big opportunity and perhaps need is self-generation and innovating in utilities. What I mean by that is solar heating, for example, can save water heating bills, as it is already in perhaps millions of homes in India, but more in the southern part of India where I have seen it. Similarly, solar can drive power requirements for remote applications. Going back to Australia, a friend originally from Delhi who lives in Sydney says his Tesla car is totally charged with power from his rooftop solar, and he also pumps energy back into the grid. So his electric, at least the mobility, is truly electric, he says. It's something for a hobby for him too, to see if he can take less and less power from the grid and one day be totally independent of the grid. India needs more applications like this, which will decentralize and reduce distribution costs and friction. It's an almost Gandhian way of self-sufficiency if you think about it, except that it's not in a way that he perhaps would have imagined. And that brings us to the top stories and themes for the day. The stock market slipped further as the bottom stays weak. Oil is at its lowest since June 2023. Auto sales fall again and inventories rise further. Singapore, which controls 11% of the global semiconductor market, to partner with India for new projects.
This is the Core Report with Govindraj Ethiraj.
The markets trudge along. The stock market stayed weak for the second day after a 14-day non-stop winning streak that led to much awe and surprise amongst market watchers. The benchmark equity indices were down, thanks also to some sustained selling in Reliance Industries, among others. The BSE Sensex fell 151 points to close at 82,201, while the Nifty 50 dropped 53 points to end at 25,145. Analysts told Reuters there appeared to be a defensive shift underway in the equity markets. Global macro uncertainties appear to be coming at a time when the domestic equity valuations have been expensive, they said. According to Reuters, the India rally is also ramping up its index weighting and creating a dilemma for global fund managers who own around 16% of Indian stocks. So the question for them is, should they be passive as their relative exposure shrinks while the market grows, or buy in at high prices and stretched valuations? The response apparently is to either buy smaller companies or smaller cap stocks or look at other emerging markets. Now, in the last few years, India's weight in the MSCI Emerging Markets Index, which is also the benchmark for global emerging market funds, has gone up to 19%, up from just 8% 4 years ago. And there are estimates which say it could touch 22% by the end of the year. China's weightage in the same period, and we've talked about this earlier, has collapsed from 40% to 25%, according to that MSCI data. So, managers would need to buy Indian companies to keep up or keep pace with the indices. But the problem is valuations. The 12-month price to earnings ratio for India for big and mid-sized companies is 24 times, and that's the most expensive in major markets, according to LSEG data. So investors are staying underweight. So valuations for Chinese blue chips, by the way, is lower, with the same price to earnings measured at 17, and for big Malaysian stocks at 15. All of this is from Reuters. Now, all of this also means that broad market rises are more likely to be driven by domestic investors, which you could say is good news, but it could also not be very good news if the news flow goes against us. Meanwhile, on Wall Street, Nasdaq futures declined on Thursday, open as investors dumped risk assets and concerns mounted over the outlook for the US economy, according to CNBC, which also said that investors were getting out of popular technology and chip stocks. Nvidia and Advanced Micro Devices, Meta Platforms, Microsoft, and Alphabet were all down. Fresh labor market data on Thursday sent mixed signals about the health of the US economy, and there are questions over whether the Federal Reserve is now behind the curve on rate cuts, according to CNBC again. Oil prices hold at lows. So now oil prices are holding near the lowest close since June 2023, as an industry report pointed to a big draw in US crude stockpiles, with the market taking a breather following a sharp sell-off this week, according to Bloomberg. Brent is hovering around $73 a barrel after losing about 8% since the start of the week. The American Petroleum Institute reported crude inventories dropped by about 7.5 million barrels, according to people who spoke to Bloomberg. And that would be the biggest decline since June, if confirmed by official figures that will come later. Oil has inched higher slightly thanks to OPEC, that's the Organization of Petroleum Exporting Countries, agreeing to postpone a planned production increase, or at least coming close to an agreement to postpone that planned production increase. So Bloomberg says that the key coalition members of OPEC Plus likely will not go ahead with a scheduled hike of 180,000 barrels a day in October, according to delegates. Now, all of this comes, as we've been talking about, in the backdrop of falling prices in recent days amidst weak economic data from China and the United States, which are also the two top consumers. Auto sales struggle. So it's quite amazing how sequential bad weather, ranging from heat waves in summer to heavy rains in recent weeks, can affect demand, in this case for cars. Something you would think people would buy if they made up their minds to do so at some point or the other. Latest figures for August from India's car dealers are showing that car sales have fallen about 3.5% month on month in August and about 4.5% year on year. The fall in itself is not so worrisome, but the context in which it is happening, which is a massive pileup of inventory with dealers across the country, is obviously worrying. The Federation of Automotive Dealers Association, which represents about 15,000 automobile dealerships with 30,000 dealership outlets, says that even with the arrival of the festive season, the market remains under significant strain due to delayed customer purchases, poor consumer sentiment, and those persistent heavy rains. Inventory levels are now at 70 to 75 days, and inventory totaling about 780,000 vehicles valued at about 78,000 crores are sitting with dealers. The FADA says that car makers are still dumping cars on them, despite the fact that this is putting financial pressure on them. Elsewhere, commercial vehicle sales have also slowed down. I reached out to Manish Singhania, president of FADA, and I began by asking him whether these rising inventories were reflecting something larger. In this somewhat longer conversation, I also tried to touch upon various other aspects, including why consumers were postponing their purchases and what the outlook was.
So even though we are seeing a degrowth of almost 4.53% in PV on a YOY basis, primarily we have attributed that to 16% excess rainfall. There can be a few more reasons that we get pinned down upon. First is we have a very high base in last year. We had created a lot of new records last year, and crossing those numbers every month won't be possible. So factors would be influencing differently for this year, and last year it would be different. That can be one probable cause. Second is, if you compare with BS4 era, the average price of acquisition for PV was around 6.5 lakhs. Now, average price of acquisition of a PV has gone up to 11 lakhs average. So the entry level or the average price point of such a high price point will lower the customer base as such for the car buyers. So we can definitely see a lot of PV manufacturers rolling out huge scheme, also cutting down on prices. Thirdly, I think we should note that compared to, like, say, if the car prices has gone up by almost 75 to 80%, I don't see income of people rising to that level. Almost 70% rise in salaries in 4 year or 5 year time is not there. This can be a momentary plunge also that was affected by certain conditions. And the degrowth is not drastic degrowth. It's still small single digit growth, which we can very well be covered in the next month or the coming festive season.
Okay, so just to pick up on that figure, you said car prices are up 75 to 80% in 4 to 5 years
Yeah,
on an average. So, and that's the figure of 6.5 lakhs that you quoted, which was the median price earlier, which is about 11.5 lakhs now.
2019 to 2023, 24.
Right. And within the car models and within the price bands, what are the kind of trends you're seeing, which is going faster maybe, or which is going less?
There is no doubt that the SUV is ruling the roast, getting the maximum advantage. The people choices have changed and are totally inclined towards the SUV. If you see 90% of the models, new models that are being launched are all SUVs or, closer to the SUV types, which can cater to large spaces, feature-rich vehicle and accessible vehicle, and, we can play around with the vehicle. So I think the fancy for SUV still continues. For the coming couple of years, this would be the segment which will continue to growing and moving.
Right. But when the overall numbers are low, and I mean, there is clearly degrowth, as you've said, that would imply that all segments are slowing down, maybe some more than the others.
So yes, definitely the entry level hatchbacks, sedans, the numbers of share has constricted quite a lot. SUVs are now contributing almost 63% of the total PV retail. That's a major chunk of retails that is going to SUVs.
And broadly, I know you've been saying that entry level models are facing pressure because people are not able to take loans for down payment. I mean, that could be one reason. Is that a trend that you see continuing right now?
So there are multiple reasons here. For entry level, also cost of acquisition has gone up by almost 60-70%. Although entry level initially would be at 2 lakhs, now it has 4.5 lakh vehicle. It's a difficult, and the stress of COVID, job losses during the lockdowns, and all this has affected the entry level the most. And recovery of that particular segment is also very slow. The urban Uber of India, they have got plenty of money to spare. But this segment has to earn back that money and generate some extra savings so that they can invest in the luxuries of life or necessities of life. So recovery has been slow in that segment. But yes, the overall good economic outlook that we are seeing and overall good economic performance that we are seeing will definitely see a traction in this segment in coming years.
So Maruti, for example, feels that by next year we will see pickup in this entry level segment. So you're in agreement with that?
Yeah, pretty much. Because please understand, for automobile, for that segment, it is not a luxury. It's a necessity in India. We always quote that public transport is not very good or even available in tier 2 or tier 3 cities. Tier 1 has the leverage or luxury of public transport. But rest of the cities, you have to own a vehicle if you want to transit from point A to point B. So it's a need that would drive this revival of that market.
So you're saying that at the entry level, therefore, people will be able to buy next year or put down money because they would have managed to save more, or you feel incomes will improve? I mean, but what's the more basic assumption that is driving this?
So overall, looking to the income trend of urban and rural, if you see, it has been steadily improving. And we had expected, especially the rural, since last November or December, we were seeing rural contribution increasing in overall sales. But due to the extreme heat wave and the monsoon that we are seeing, if we don't have a proper quality quantity of crop, the expected rural sales will not come because you won't have the right quality and quantity of crop. Even though MSPs have increased MSP will ensure that enough fund flow is there in the rural market, and eventually some of it will definitely flow back to automobile market.
So, Manish, there's clearly a discrepancy between the data points as far as inventory is concerned between what you are claiming and what even companies like Maruti are claiming. So, why is there a difference?
See, FADA only talks on hardcore data. We have been maintaining the database since the launch of Vahan, and we are actively involved in the launch of Vahan with Morten. And also on a day-to-day basis, we work very strongly with Mort. And the database has been with us since those time, almost now 7, 8 years now. And kindly understand the wholesale is declared by SIO, all the OEMs. We don't declare it. And we take the retail figures from Vahan, which is a government website. And we also add to it a certain percentage of Telangana retail. And we get the total retail. So we have a total wholesale, we get the total retail and subtract it, and accordingly we get the total stock available across India. See, the mockery is when we quote a stock level of 30 days or 40 days, nobody is questioning that data. Okay. Right now, the two-wheeler paid-up stock is only 20 days. Nobody is questioning the data. As soon as we put up a higher paid-up day stock or a higher quantity of days, everybody starts questioning this data. So what is the logic behind this? I also wish to understand that. But please understand, at FADA, we only talk only on the hardcore data.
Okay. And that data is really what you're saying is registered when the cars arrive at your dealership with the Vahan portal, which is the government of India.
That is the wholesale. And when we sell a vehicle, we get the registration done. And then registration is reflected in Vahan. If I get, say, 100 vehicles built and I register 20 vehicles, so my stock would be automatically 80 vehicles. No.
Right. Got it. So you're now saying that your inventory levels have increased even further. So despite, let's say, all the representations made to the car makers last month, the number of cars that are being sent to you are much higher. Why is that happening?
I think this is not the right question to be answered by me. Car makers should answer it. We have been very actively giving out figures about the quantity of vehicles available and the value of vehicles available at the dealership. In fact, if you look at the August figures, the dispatches are at 3.54. If you configure the Telangana retail in Vahan retail, a certain percentage that we do, that is 3.23 comes to, and the wholesale is more than retail by 21,000 vehicles. So, in spite of all our representation about all our warning about high stock level, the OEM continue to dispatch more vehicles. I think they really need to align with their retail goals. Where exactly do they stand, and should not be over ambitious and just dumping cars at the dealership will not be a solution unless until that vehicle has a trade plate or is retailed and the doesn't hold any value, and the health of the dealership is drastically affected. We'll see financial losses happening at the dealership across board wherever the inventory is high. And the OEMs, though there's an expectation that with the festival season, retails would be good. But correcting such a high inventory in 1 or 2 months is not possible. It will take 3, 4 months. And every month, the difference between wholesale and retail has to be minimum 50 to 70,000. Then possibly there could be a correction.
And most of the models that, let's say, are now sitting with the dealerships, are they mostly of a certain type or is it equally distributed?
See, now every OEM, more or less 80-85% of the range of models that are there at the dealership are amply available at the dealership, heavily stocked at the dealership. There are few models definitely with every OEM which continue to command waiting periods, and we do not see any schemes or any type of schemes on those models which continue to command waiting period. See, here is the mockery. There are models which are commanding waiting period which are not available at the dealership, and there are models which continue to get dumped at the dealership at a certain wholesale quantity. Here, the OEM have to be more vibrant. They should be able to produce as per the market demand and requirement rather than pushing a certain quantity of models at the dealership. The customer requirement needs to be addressed rather than just pushing numbers to the dealership.
Okay, so a point that you had made earlier, and I just want to revisit it, is that, when people don't come to dealerships, they typically postpone a decision. And the behavior is almost like a consumer product or a perishable consumer product. You want to go to a restaurant, if it's closed, you don't go back again or not go back for a long time. And that, as I understood, is also something that you see at dealerships. Is that something that's affecting sales on a longer term or?
See, the preparation of buying of a vehicle, it takes time. It doesn't happen instantaneously. But what drives Indian consumer is the Murat. If a customer has a Murat or, auspicious day to buy a vehicle, and if that vehicle is not available on that particular day or the Murat day, then obviously the deal gets postponed. And it can be indefinitely postponed also. So we Indians as such are very particular. That's why dealers also during the pre-festival time, we tend to accumulate stock also so that we are able to address each and every requirement of the consumer. We have a variety of models now, range of models that we need to keep, and color combination, diesel, petrol, automatic, manual, sitting combination, whatnot. But we need to keep a lot of things in stock so that we are able to address this Murat requirement of the customer. So that, say, if a customer doesn't get his choice of vehicle during Diwali or, Dhanteras, then after Diwali, you start calling you up, sir, aapki gaadi aa gayi, to bole, dekhte, I'll come back to you. And on Diwali, if he has moved, if he has moved, he can buy any goddamn vehicle and take it to his home or her home.
Right. Manish, thank you so much for joining me.
Thank you, Govind. Thank you.
Singapore and India to partner on semiconductors. Well, Singapore and India have signed MOUs to leverage strengths and build on semiconductor supply chains. This MOU was signed during Prime Minister Modi's visit to Singapore yesterday. India should benefit from the ecosystem development part of the MOU and, of course, the supply chain linkages. Reuters says that tiny Singapore accounts for 11% of the global semiconductor market and 20% of global semiconductor equipment is manufactured there. All of this is news to me too. India is building 3 semiconductor plants right now worth about $15 billion to manufacture and package chips which could target sectors like auto, defense and telecommunication. India is not manufacturing the more modern, smaller nanometer chips used for the latest iPhones and the like. India has some $10 billion of subsidies open for these plants. Now, there is a global race involving subsidies to set up semiconductor capacity, and countries from the United States to Germany, being the latest one, are setting up massive fresh capacity in very large projects with, of course, very large subsidies as well. Okay, and before I go, here is some feedback from all of you. And thank you once again for taking the time off to keep writing into us. Joe Skoshi says on YouTube that, Govind, I love the unique content and analysis and presentation you have. This is not there in the mainstream. Keep it up. Jaka says good topics and content. And finally, Prasad, also on YouTube, says he liked the weekend edition featuring Shashi Kiran Shetty, the chairman of the All Cargo Group, and says it was a very insightful discussion. So thank you all once again. Do send in your feedback. We take it very seriously and we try and respond to it because much of the feedback is also to do with what you would like to see. And I can assure you that we're all working hard at it. Thanks once again. Have a great weekend. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.